Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning again. Welcome to exactly mid-June, June 15th, about 1 week away from the official start of summer. Lots going on in financial markets, as has been the case for quite some time. Going to talk about that, talk about a couple of stories over the weekend in Barron's, a few different ideas, and then turn it over to Brad for his insightful commentary. Getting started this morning, want to talk about human bias, how we're hardwired, some topics we've discussed before, but I think it's come even more to light here in the age of the violent swings that we've seen in the market, the volatility that we've seen, and Hartford Funds recently had a client conversation piece which compared when individuals do a Google search for CNBC and how that correlates to the S&P 500. And what you will see if you look at this report is that Google searches for CNBC, when investors are seeking out financial news, they tend to spike dramatically on bad news and tend to have almost no influence on good news, meaning that we are hardwired to seek out bad news and to read about bad news. Perhaps it's a survival instinct. So what the Hartford report pointed out is if you go all the way back to the Great Recession, Google searches were up almost fourfold at the heart of the Great Recession for CNBC. Google searches were up almost threefold when the U.S. credit rating was downgraded, and Google searches were up almost fivefold at times during this pandemic, highlighting that individuals are emotional creatures and that we seek out negative news, perhaps as a survival instinct. We don't seek out good news because when things are good, we don't need to be on heightened alert to make sure that we survive. Now, what is the investing relationship between the seeking out of bad news? Well, seeking out of bad news also drives investment decisions. Those emotions are significantly correlated with our search for bad news. And what does the data show that we do as investors when there is bad news? And this is where an advisor can step in and help smooth out those emotions and not make those emotional decisions when we are seeking out and constantly being bombarded with bad news. Not only just seeking it out, but the reason that we're possibly seeking it out is we hear it on the radio, we read it on the internet, we see it on Facebook, we see it on Twitter. And then what do investors do? Well, MFS wrote a piece. What investors do is they pull money out of the market. And they had a study that says don't let emotions drive decisions. And what do investors do? Well, unfortunately they sell low and they typically buy high. But they sell low more than they buy high. So when the markets are down the most, MFS study shows that's when mutual fund redemptions are at their highest. So when did we see significant redemptions in mutual funds? Right at the bottom in 2000 and 2001. We saw redemptions very strong in 2008 and 2009. And then again here during the pandemic, we saw very significant drawdowns of investments, specifically in mutual funds. And what does that translate into? That translates into the average equity investor's returns in mutual funds over the last 20 years, actually 19 to be specific, 2000 to 2019. The average equity fund investor has earned 4.25%, according to this study in the markets. The S&P over that period has earned over 6%. What's interesting is the average fixed income investor who for a long time thought interest rates were going to shoot higher. The average fixed income investor over the last 20 years has earned 47 basis points, whereas the Barclays Ag is up almost 5%. So those expectations of those higher interest rates has led fixed income investors over that period to tend to invest in much shorter duration assets and perhaps reach for yield, which sometimes leads to poorer performance. So very interesting there that the average mutual fund investor in fixed income has even more significantly underperformed the average equity investor, who's underperformed almost 2%. So what is perhaps a solution to those emotional roller coasters and those emotional decisions? And Hartford did another study, and they compared buying and holding over that same time period, roughly the last 20 years. And if in 2000 you invested about $100,000 into the market and you held it, you'd have about $289,000. If you had rebalanced that portfolio annually, and this is where rebalancing comes in, and this is assuming a 70-30 split between equities and fixed income on all accounts, if you had rebalanced that portfolio, that $100,000, instead of growing to $289,000, would have grown to about $314,000 just by annually rebalancing that portfolio over the last 20 years. Would have picked up almost $25,000 in additional gains. And if you had rebalanced that portfolio not annually, but you would rebalance that portfolio to 70-30 every time there was a drop of 20% or more in the S&P, and use that as your rebalancing criteria, instead of having $289,000 from not rebalancing, $314,000 from rebalancing annually. If you rebalanced only when you had a 20% decline, $334,000 would have been your total. So some strategies perhaps to take the emotion out of the equation, as we are once again in a highly uncertain emotional time. So speaking about uncertainty and emotions, last week markets dropped almost 1,500 points. We saw a very large pullback Thursday of last week of over 1,800 points. We saw a little bit of a rebound of about 480 points, and I'm speaking of the Dow here on Friday. And this morning we are seeing futures lower, Dow futures back down 635 points. S&P futures are down about 60, NASDAQ futures down about 130, and we're seeing weakness across the board in Asia and Europe. Europe outperforming down about 1%, Asia ranging from down 1% in China, in the Shanghai, to 3.5% for the Nikkei. We are seeing the dollar relatively flat and commodities down across the board, including gold, which is down about 1.3% or $23 an ounce. Oil down over 3%, down about $1.20, talking about Brent crude, to about $35 per barrel. And we are seeing a flight to safety in the Treasury market, where we are seeing Treasury yields slightly lower by 3 to 4 basis points in the 10-year range, and relatively flat and unchanged in the short end of the market, where the Fed has indicated that they plan on keeping rates at or near zero through 2022. Perhaps that outlook that Chairman Powell gave last week on Wednesday after the Fed came out with their decision on interest rates, his sobering forecast, one of the catalysts perhaps for the markets selling off. The other catalyst is worries about reopening the economy. We're seeing growing cases in Arizona, California, Florida, and Texas, as well as a new outbreak in China, where the Chinese have closed a market in Beijing and have instituted much stricter controls in Beijing on concerns that there may be an outbreak there. Also, China reported data that came in below expectations. Their industrial production rose 4.4% year over year in May. Retail sales fell 2.8%. And that also contributing to investor confidence getting shakier. This morning, border checks were opened across Europe. The UK is allowing non-essential shops to reopen. Some other news is Dr. Anthony Fauci, according to CNN, said recent increases in corona cases in some areas is not necessarily a second spike. He also says it is not inevitable that we will have a so-called second wave in the fall. I mentioned some states seeing an increase in coronavirus cases. New York Times reporting that 22 states have rising cases, 9 have flat cases, and 19 have declining cases. New York Governor Cuomo, once again in a little bit of a spat with Mayor de Blasio in New York, threatening to shut down parts of New York after there were 25,000 business violations, particularly bars and restaurants in Manhattan and the Hamptons. White House economic advisor Larry Kudlow says he expects a V-shaped recovery, and he wants to offer a $600 incentive for Americans to return to work because he believes enhanced unemployment benefits are a disincentive to work. I can personally attest, listening to some of my friends, my son's friends, speak about some of their jobs where they have some waiting jobs and things like that, that they are very much of the mindset that they want to wait until their unemployment benefits run out because they're earning more to not work than to work. So I can see why that incentive may make sense from a personal anecdotal story. ABC News is reporting that a majority of Americans feel comfortable eating at a restaurant, staying at a hotel, or going shopping. However, only 44% of Americans feel comfortable flying in an airplane. Couple of other stories, companies in the news this morning. Shopify up about 6% this morning. SHOP, they reached a deal with Walmart that will expand the company's reach, according to Bloomberg, also upgraded this morning by an analyst. Moderna, mRNA, working on a coronavirus vaccine. News that Israel is close to a deal with the company to supply an experimental coronavirus vaccine. Broadcom, which is down about 2% this morning, despite being resumed with an outperform rating at Credit Suisse, where they have a $400 target. JP Morgan's down about 4% this morning among general weakness in the financials this morning. What do we have going on this week? Tomorrow we have Fed Chair Jerome Powell scheduled to testify before a congressional hearing, and this is Tuesday and Wednesday, his semi-annual monetary policy report. Obviously, investors carefully listening to what he has to say. Also tomorrow we get earnings from Lennar and Oracle. Also tomorrow we get retail sales. Economists are expecting a 6.3% jump in May after a 16% drop in April. Also get indication on the housing market. We get the National Association of Home Builders releasing their index for June. That's expected to rise to 42 from 37. Then Wednesday we get residential construction data for May. We also have OPEC and its allies, including Russia, holding a two-day meeting to review market conditions and policy recommendations. Thursday we get earnings from Kroger. We also get the leading economic indicators, which are expected to rise 1.3%, and we also get initial jobless claims. Moving on to Barron's. Barron's had a article entitled "The Stock Market Got Crushed Last Week." I mentioned down 1,500 points, and they say why investors shouldn't worry. This, despite the pullback we're seeing this morning. Barron's article talking about the fact that the bears finally got the pullback they've been waiting for ever since the stock market's blistering rally got underway in late March. But investors didn't learn anything in the past 5 days. They say they should have shaken their conviction in a market rally led by economically sensitive stocks. What caused the rally to sputter last week? Barron says nothing particularly new or unexpected. On Wednesday, Fed Chair Powell emphasized the slow path back, in contrast to the market's lightning-fast recovery. Nothing really surprising there in his testimony. Also, not surprising that with the economy reopening, that coronavirus cases, as we talked about this morning, are increasing, but still coming after a more than 40% surge since late March, and with many of the market's coronavirus-sensitive companies more than doubling from their lows in just weeks. Conditions were overbought and ripe for a slide. A catalyst for a pullback, they say, They don't think it's something more serious. Why do they think that? They think that because the factors that boosted the markets in the most recent weeks are still predominantly in place, which is a flood of liquidity from the Fed, what's expected to be better economic data after the disastrous economic data we saw from March, the fact that consumers and corporations are adjusting to life and business in a coronavirus world. Together they point to improving corporate earnings and perhaps justify higher multiples. They say the coronavirus data will get plenty of attention in the coming weeks and will be a source of choppy trading on particularly good or bad days. But U.S. knowledge, capabilities, and priorities are very different going into the second wave than they were back in February and March, and therefore the consequences, they believe, are less dire. Equity strategist at Morgan Stanley saying, I think that the way we deal with the second wave will be very different than the way we dealt with the first wave. From an economic standpoint, he said he doesn't think it should be as troubling. This analyst at Morgan Stanley last week identified some cyclical stocks that he thinks are attractive at current levels. These include General Motors, GM, and Lyondell Basel Industries, symbol LYB. What is a greater concern than a second wave, they say, is action or inaction that Congress may take with respect to additional stimulus, or tied to that stimulus, whether or not they extend funding for the Small Business Administration's Paycheck Protection Program. So the ultimate conclusion is the greatest concern for the market, at least according to this article, is whether or not there is more assistance for the economy from the government. If not, then perhaps it will be more challenging. If there is more assistance, they feel that a recovery will take hold and the roots are in place. Article also emphasizes that one of the most critical pieces of assistance coming from Congress would be to assist state and local governments, something Brad's talked about in the municipal market. But state and local governments have a mandate to balance their budgets, and if they are running significant deficits, as they are with tax revenues down significantly, they will be forced to furlough workers. This is something that happened in a meaningful way in the 08-09 recession, and will happen to an even larger extent in this current environment. And since state and local government employment represents about 11% of all the employed personnel, significant cutbacks there could certainly meaningfully impact and slow down the economy without some assistance to state and local governments for their effects of the coronavirus on their economies. Barron's wrote an article, the headline story, talking about dividend-paying stocks. Dividends are down but not out, and they said they came up with a list of 8 stocks for the COVID crisis. They talked about the fact more than 3 months into the pandemic, U.S. investors should step back, take a deep breath, and assess their dividend stocks. Because the picture is mixed. So if you bought stocks because they pay a dividend, you're counting on that income, got to reassess what's going on, and whether or not that company can continue to pay that dividend, or at least pay a dividend at all. During the pandemic, the number of dividend cuts, actually dividend suspensions, relative to dividend cuts is about 2 to 1. So for every one company that cut the dividend, 2 suspended it. In the 08-09 financial crisis, that ratio was 7 to 1. So suspensions relative to cuts running lower than 08-09. But going back to that list of companies that they feel can not only maintain their dividends but grow them, on that list is Home Depot, which is yielding about 2.4%, Johnson & Johnson at 2.7%, McDonald's at 2.6%, Procter & Gamble at 2.7%, Roche Holdings at 2.7%, Texas Instruments at 2.7%, and Lam Research, LRCX, at 1.5%. One company mentioned very favorably in Barron's, Goldman Sachs, symbol GS. They say they like Goldman Sachs because Wall Street is recovering faster than Main Street. They feel that Goldman Sachs' strengths, their strong risk management, their powerhouse investment bank, and their new CEO, David Solomon, who is pushing them into building out an online banking franchise. He's also pushing them to broaden relationships with corporate clients, and he's expanding their lucrative asset management business, which includes private equity, all potentially driving profits higher, and perhaps the stock as well. Barron's surmising that the firm is well positioned for the current environment with corporate and institutional focus, and perhaps most importantly, little exposure to consumer and small business lending. And Goldman stands to gain from ultra-low interest rates, different from their rivals whose margins are under pressure. Its huge trading business had a blockbuster first quarter, and many are speculating that the second quarter could look similar, given that there's been lots of volatility and lots of volume. Mike Mayo, the well-respected banking analyst at Wells Fargo, says Goldman has less exposure to credit and interest rate risk relative to the average bank. It has 3 times more capital per dollar of loans than the average bank. It's one of the best risk managers in financial services, and its investment bank, its bread-and-butter business, is still best in class. The stock, before the open today, was trading around $200, which is trading below its tangible book value of $215. The stock is no higher than where it was in 2007. Goldman has a market value of about $70 billion, one of the largest of the 6 U.S. banks. And if you look at its market cap right now, it's less than half the size of PayPal, PYPL, to put it in perspective. Key event to watch for Goldman will be the results of the annual stress test, which results will be released on June 25th. Goldman has a very modest loan book, as I mentioned before, and the main thing that influences Goldman is not loan losses, but trading losses, and that is not anticipated, at least in the current quarter. Dividend yield at Goldman, 2.6%. It has one of the lowest and safest dividend payout ratios among its peers based on 2020 projected earnings. One item that is absent right now is stock buybacks, which Goldman and other large banks collectively suspended in March and are unlikely in the coming year. So that is one thing that may put a lid on things for the foreseeable future, but Barron's feels they can overcome that hurdle with the positive news that they see out there. They don't see Goldman merging with a bank, although it's a possibility, because the CEO Solomon has said that he sees Goldman as a Netflix-like disruptor in consumer banking because they don't have a high-cost network of branches and they are able to attract deposits for a very low cost. In fact, Goldman has upped their deposits in their bank to $80 billion to finance their business. That's up from $46 billion in the first quarter of 2019. At the same time, despite the fact that they are using that bank to raise deposits in order to fund their business, they have been very cautious on their consumer loan portfolio. The consumer loan portfolio comes to $128 billion. It's less than 15% of their assets, but perhaps most importantly, 78% of their loan portfolio is secured. Goldman also made very heavy investments in technology, including electronic trading platforms, which has helped them tremendously, with 98% of their workforce in lockdown and working and trading from home. But Goldman has said that they feel that their culture is very much a face-to-face interaction culture, and they want to get people back into their offices as quickly as is reasonably possible. To take a look at their revenue mix, 40% of revenue last year came from trading, 25% from investment banking, and the rest from consumer and wealth management. One scandal hanging over Goldman is the 1MDB scandal, which involves Malaysia's sovereign wealth fund. Goldman raised $6 billion for them. The fund says that Goldman acted improperly. Goldman set up $2 billion in legal reserves in 2018. Malaysia claims that sum is not enough. Analysts expect there to be a settlement sometime in the future. Looking at projected earnings, analysts speculating that in 2022 or 23, when earnings quote-unquote normalize, that Goldman can earn somewhere in the neighborhood of $24 a share, which would mean the stock is trading at around 7 times normalized earnings. Nevertheless, those normalized earnings are a couple of years away. I'm going to turn it over to Brad for a few comments. Good morning, Brad.
Morning, Keith. Good morning, everyone. Hope everyone had a good weekend. I actually did nothing this weekend. I didn't read anything about business. I didn't really prepare anything to say. But I always have something to say because when you're talking about municipal bonds, you're talking about everything that's going on around you at all times. So this weekend, what really caught my attention was the future of public transportation in cities. I was walking through Manhattan this weekend, and I see all the young people on these new Revel motorbikes, on city bikes, on skateboards, walking, jogging. Now, granted, it was a weekend, but I do think that this is going to be a trend for younger people in cities, and I think that this is going to have a direct impact on the MTA in New York City, the revenues of the MTA, as well as public transportation in other cities. Obviously, the solution would be for these cities to purchase these alternate forms of transportation so that they can share in that revenue as well. I do think that other forms of transportation will return at a certain point, car travel, interstate train travel, and air travel. But obviously, for the foreseeable future, people are still going to be working from home, and a few people I saw this weekend who are real estate developers who would tell me that they would have national and international real estate deals, and they'd visit sites 20 or 30 times. They're all telling me that now they're going to visit the sites 2 or 3 times. And the other meetings that don't have to be on-site will be some form of Zoom or WebEx type meeting or FaceTime. The people have learned that there is not the same necessity to travel for business, and this trend, in my opinion, will have a short-term impact on transportation-related municipals. Someone came on CNBC this morning and talked about the insanity of Hertz, a bankrupt company that's attempting to do $1 billion equity deal, and that's frankly how I feel about the New York MTA. They were in a lot of financial trouble beforehand, and like so many other operations, the Fed is keeping the MTA as well as some of these other transportation authorities solvent. So that's my 2 cents for the morning. I don't want to scare anyone. My opinion is only my opinion, but I like to report on what I'm seeing in conjunction with my experience in this business. Liquidity has been solid in the municipal market. If you want to sell, there are bids, and the bids are strong. And if you want to buy, I suggest you buy what was strong before the pandemic hit, even if it means that you're going to get a lower rate of return. The municipal bond portion of the portfolio in a low-interest rate environment is defense, conservation of principal and capital, and in a different type of market with higher interest rates, we can talk about different types of investments. But this is all my opinion, and I'm here to talk. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.